Here's something that makes absolutely no sense until you understand the mathematics behind it. James Simons, a mathematician who never took a single business course, never studied traditional finance, and spent the first half of his career solving abstract equations that most people couldn't even pronounce, walked into Wall Street and proceeded to generate returns that made every MBA-educated fund manager look like they were guessing randomly. Between 1988 and 2018, his flagship fund averaged returns of approximately 66% annually before fees and 39% after fees. To put that in perspective, if you had invested $10,000 with Simons in 1988, by 2018 you would have had approximately $84 million. Warren Buffett, widely considered one of the greatest investors in history, averaged around 20% annually during his peak decades. The S&P 500 averaged about 10%. So what was Simons doing that was so radically different? The answer isn't what most people think. It wasn't that he was smarter, though he certainly was brilliant. It wasn't that he had better information, because he deliberately ignored most traditional financial news. It wasn't even that he had better technology, though Renaissance technologies did employ cutting-edge computing. The real answer is far more interesting and applicable to anyone trying to build wealth, regardless of whether you have a PhD in mathematics or barely passed high school algebra. Simons succeeded because he fundamentally rejected how everyone else was thinking about markets, and he replaced emotional reasoning with something the human brain finds extremely uncomfortable: pure probability thinking. This is a story about cognitive transformation, about what happens when you force yourself to think in ways that feel wrong but are mathematically right, and about why the vast majority of people will never make this shift even when shown the evidence. Let me take you through this transformation step by step, because understanding it might be the most valuable financial education you ever receive. The starting point for understanding Simons' approach requires us to examine what he rejected. Traditional investing in the 1980s, and honestly still today, was dominated by what's called fundamental analysis. Fund managers would study companies, read financial statements, attend earnings calls, meet with management teams, and then make predictions about which stocks would outperform. The underlying assumption was straightforward. If you gather enough information and think hard enough about that information, you can predict which companies will succeed and therefore which stocks will rise. This approach seems logical. It's how we make most decisions in life. If you want to predict whether it will rain tomorrow, you look at clouds, check the weather forecast, feel the humidity. If you want to predict whether a restaurant is good, you read reviews, look at the menu, maybe check how crowded it is. Prediction through information gathering is deeply embedded in how humans approach uncertainty. But here's what Simons recognized that most people miss. Markets aren't like weather or restaurants. Markets are what mathematicians call complex adaptive systems, meaning they're composed of millions of independent actors all trying to outsmart each other, all processing information simultaneously, all adjusting their behavior based on what everyone else is doing. When you're trying to predict in a complex adaptive system, something fascinating and frustrating happens. The act of gathering information and making predictions actually changes the system itself. If everyone knows a company is likely to succeed, that information gets priced into the stock immediately. The opportunity disappears the moment it becomes obvious. According to research published in the Journal of Finance, analyzing decades of mutual fund performance, approximately 85% of actively managed funds failed to beat their benchmark index over 15-year periods after accounting for fees. Think about what that means. These are professional investors, many with Ivy League educations, teams of analysts, access to company management, decades of experience, and 85% of them couldn't consistently beat a simple index that just owns everything and does nothing. Simons looked at this evidence and asked a different question. Instead of asking how to get better at predicting, he asked whether prediction was even the right framework. This is where the transformation begins, and this is where most people's brains start to resist. Because if you can't predict markets, what's the alternative? The alternative is probability thinking, and it requires accepting something deeply uncomfortable. You can be right about probabilities and still lose on any individual bet. Let me illustrate this with a thought experiment that Simons would have been intimately familiar with from his mathematical background. Imagine a casino offers you a game. You flip a coin. Heads, you win $60. Tails, you lose $40. Should you play? Most people's intuition focuses on individual outcomes. They think, well, I might lose $40, and that would be bad. But that's prediction thinking, focusing on the next single event. Probability thinking asks a different question. If I play this game 100 times, what's my expected outcome? Mathematically, each flip has a 50% chance of winning $60, which contributes $30 to your expected value, and a 50% chance of losing $40, which subtracts $20. Your expected value per flip is $10. Play 100 times, and probabilistically, you'd expect to win about $1,000. Now, here's the critical part that separates people who understand Simon's approach from those who don't. Even though your expected value is positive, you will still lose roughly 50 times out of those 100 flips. You will experience failure constantly. Your intuition will scream at you that the game is broken, that you're doing something wrong, that you should quit. This is exactly what happens to most investors. They find strategies with positive expected value. They experience the inevitable losses that come with any probabilistic system. Their emotions override their mathematics, and they quit right before the probabilities would have worked in their favor. Simons built Renaissance technologies on the foundation of finding thousands of these tiny, probabilistic edges. None of them individually predictive, but collectively powerful when executed systematically. His team, composed primarily of mathematicians, physicists, and computer scientists, rather than traditional finance professionals, would analyze massive datasets looking for subtle patterns. They might discover that when certain obscure economic indicators moved in particular ways, or when trading volume behaved unusually at specific times, or when correlations between seemingly unrelated assets shifted, there was a 52% chance, rather than 50%, that a price would move in a particular direction. 52% doesn't sound like much. It wouldn't even be visible to human intuition. You couldn't feel that edge. But if you execute 10,000 trades based on that 52% edge, the mathematics becomes inexorable. According to analysis of Renaissance's methodology published in research from the University of California examining quantitative trading strategies, the firm typically held positions for extremely short periods, sometimes just minutes or hours, and their win rate on individual trades was often only slightly better than chance. But that slight mathematical edge, repeated thousands of times per day, compounded into the most successful investment track record in history. This is the first major insight. Thinking differently doesn't mean being wildly creative or unconventional in some artistic sense. It means being willing to act on mathematics even when your intuition rebels against it, even when each individual action feels uncertain, even when you're losing regularly. Most people can't do this. Their brains weren't designed for it. According to research from behavioral economists Daniel Kahneman and Amos Tversky, documented extensively in their prospect theory work, humans feel losses approximately 2 to 2.5 times more intensely than gains. This isn't a character flaw, it's evolutionary wiring. For most of human history, a loss could mean death, so we evolved to be loss-averse. But that same wiring that kept us alive on the savannah makes us terrible at probabilistic thinking in markets. Before we go further into how Simons trained himself and his team to overcome this evolutionary wiring, I want to pause and ask you something directly. Are you the type of person who makes financial decisions based on how they feel in the moment, or based on what the mathematics suggests over time? If you said mathematics, then subscribe to this channel right now, because everything I share is backed by research from institutions like the Federal Reserve Economic Database, the Bureau of Labor Statistics, peer-reviewed academic journals, and analysis of actual market data spanning decades. I don't do hype. I don't promise shortcuts. I demonstrate mathematical frameworks that actually work when applied consistently. About 97% of people who watch this video won't subscribe. They'll watch. They'll learn something valuable, but they won't take the action. Be part of the 3% who thinks differently. Subscribe now. The evolution from probability thinking to what Simons actually implemented requires understanding a second layer of cognitive transformation. Recognizing that markets are probabilistic rather than predictive is step 1. Step 2 is far more challenging, accepting that you cannot know which of your probabilistic edges will work and when. This sounds similar to the first point, but it's critically different. Most people, when they learn about probability thinking, immediately start trying to predict which probabilities will win. They look for the best edge, the highest probability setup, the most reliable pattern. But Simons recognized something deeper. In a complex adaptive system, probabilities themselves are constantly shifting. A pattern that had a 55% win rate for 3 years might suddenly have a 48% win rate for 6 months, then shift back to 53%. If you try to predict which patterns are currently working, you fall back into the prediction trap. You start trusting your intuition about which probabilities to trust, and you're right back where you started. Simons' solution was radical. He didn't try to predict which edges would work. He diversified across hundreds or thousands of uncorrelated probabilistic edges simultaneously. On any given day, maybe 60% of Renaissance's strategies were losing money. But the 40% that were winning slightly more. And crucially, the strategies that lost today might be the ones that won tomorrow. By spreading across massive numbers of uncorrelated bets, Simons wasn't predicting anything. He was engineering a statistical inevitability. This is where Simons' background in mathematics, specifically in geometry and topology, gave him an enormous advantage over traditional finance professionals. In mathematics, there's a concept called the law of large numbers, which essentially states that as you increase your sample size, your actual results will converge toward the expected probability. Flip a coin 10 times. You might get 7 heads purely by chance. Flip it 10,000 times, you'll get very close to 50% heads. Simons understood viscerally that his job wasn't to be right about any particular trade or even any particular strategy. His job was to create a system that executed enough uncorrelated probabilistic bets that the law of large numbers would guarantee profits. Traditional investors, even sophisticated ones, typically build concentrated portfolios. They might own 20 or 30 stocks that they believe will outperform. This approach maximizes returns if they're right, but it also maximizes the impact of luck. With 20 positions, random chance plays an enormous role in your annual performance. You might be a brilliant analyst and still have a terrible year purely because your 20 stocks happen to be in sectors that underperformed for reasons nobody could have predicted. Simons took the opposite approach. Renaissance might have thousands of positions, with no single position representing more than a tiny fraction of the portfolio. According to research analyzing quantitative hedge fund strategies published by the National Bureau of Economic Research, this diversification across uncorrelated strategies is one of the most powerful risk management tools available. Yet it's rarely implemented by traditional investors because it requires abandoning the emotional satisfaction of being right about big, concentrated bets. There's something psychologically gratifying about making a large bet on something you believe in and being proven right. It feels smart. It creates a narrative you can tell yourself and others. Simons's approach offers none of that gratification. You're constantly losing on most of your individual positions. You never get to feel like a genius who called the big move. Your returns come from invisible statistical edges that you can't even perceive day to day. This is the second major insight. Thinking differently requires accepting that the path to being right overall involves being wrong constantly on the individual level. Your brain will hate this. It will feel like failure. But mathematically, it's the only approach that reliably works in complex adaptive systems. Now we reach the transformation point, the place where Simon's methodology diverges so radically from normal thinking that most people simply cannot follow. Everything I've described so far, probability thinking and diversification across uncorrelated edges, is intellectually challenging, but still comprehensible. This next part requires abandoning something even more fundamental: the human need for causal explanation. When most people look at market movements, they immediately construct narratives. The market went up today because of good economic news. This stock crashed because the CEO made a poor decision. Gold rallied because of geopolitical tension. These narratives feel satisfying. They create the illusion of understanding. They allow us to believe that if we just gather enough information and think clearly enough, we can predict what will happen next. Simons rejected this entirely. He didn't care why patterns existed. He only cared that they existed with statistical significance. One of the famous examples from Renaissance's early days, documented in Gregory Zuckerman's book about Simons titled The Man Who Solved the Market, involved currency trading patterns around holidays. The models detected that certain currency pairs showed subtle but statistically significant price movements in the days around specific holidays in various countries. There was no obvious causal explanation. It wasn't that people were rationally adjusting portfolios before holidays. It wasn't that central banks were intervening. It was just statistical noise that, for whatever complex combination of reasons, showed up consistently enough to have a tiny edge. A traditional analyst would have dismissed this as meaningless. Without a causal story, without a logical explanation, it doesn't feel like real knowledge. But Simons didn't care about feelings. He cared about statistical significance. If the data showed a pattern recurring with frequency that couldn't be explained by random chance, Renaissance would trade it. Period. This approach, focusing purely on statistical patterns without causal explanation, flies in the face of how humans are wired to understand the world. According to research in cognitive psychology from institutions including MIT and Stanford studying human pattern recognition, our brains are literally evolved to construct cause and effect narratives. When early humans saw rustling grass, those who immediately constructed the narrative that a predator might be there survived more often than those who said, "It's probably just wind." We're the descendants of the paranoid storytellers, and that serves us well in many contexts. But in markets, that same tendency toward narrative construction creates systematic errors. You see patterns that aren't there. You ignore patterns that are there, but don't have satisfying explanations. You overtrade based on news stories that feel important, but have no statistical edge. Simons trained himself and his team to resist this tendency completely. Renaissance's trading models weren't based on any opinions about whether the economy would grow, whether a particular industry had good prospects, whether management teams were competent. The models simply identified statistical patterns, calculated expected values, and executed trades. There was no room for intuition, no space for narrative, no opportunity for the human tendency toward storytelling to corrupt the mathematics. This is extraordinarily difficult to implement psychologically, Imagine being a trader at Renaissance, watching your model enter a position that makes no intuitive sense, offering no explanation, and potentially losing money for days or weeks before the statistical edge plays out. Your brain would be screaming for a story, for a reason, for some logical explanation that would make you feel smart about what you're doing. And you'd get nothing. Just numbers. Just probabilities. Just trust in a mathematical process that you can verify statistically but cannot understand intuitively on any individual trade. Most people cannot operate this way. Even sophisticated investors struggle with it. According to analysis from Vanguard Research examining investor behavior across millions of accounts, individual investors who attempt to implement quantitative or systematic strategies typically abandon them after the first significant losing period, despite those strategies having positive expected values over longer time frames. The emotional need for understanding, for narrative, for the feeling of being in control overwhelms the mathematical reality that you're executing a profitable probabilistic system. This is the third major insight, and perhaps the most profound. Thinking differently requires accepting that you can profit from patterns you don't understand, and that trying to understand them causally might actually reduce your edge. The narrative your brain constructs to explain a pattern might be completely wrong, and trading based on that false narrative rather than pure statistical reality will lead you astray. Simons succeeded because he was comfortable with mystery, as long as that mystery had statistical support. Now we can synthesize these three insights into a practical framework, though I'll warn you in advance that implementing it requires discipline most people don't have. The framework has three components, each corresponding to one of the insights we've explored. Component 1, identify positive expected value opportunities through historical analysis rather than forward prediction. This means you stop asking what will happen and start asking what has happened with statistical significance. Simons's team would analyze decades of market data, looking for patterns that recurred frequently enough that they couldn't be attributed to chance. The specific methodology Renaissance used was proprietary and enormously complex, involving machine learning algorithms, signal processing techniques borrowed from physics, and statistical methods most people haven't heard of. But the underlying principle is accessible to anyone. You can apply this thinking to basic investment decisions right now. Instead of asking which stock will outperform, ask, has any particular investment approach shown statistically significant outperformance over multiple decades and varied market conditions? The answer, according to extensive research from institutions including Dimensional Fund Advisors, analyzing global market returns from 1926 through present day, is yes. Small-cap value stocks have historically outperformed large-cap growth stocks by approximately 3 to 4 percentage points annually over rolling 20-year periods. That doesn't mean they outperform every year. Some years, they dramatically underperform. Some entire decades show minimal edge. But the statistical significance across nearly a century of data is robust. Notice the difference in thinking here. You're not predicting that small-cap value will outperform next year. You're observing that a diversified portfolio of small-cap value stocks has historically had positive expected excess returns, and you're betting that this statistical pattern will continue not because you understand why it exists, but because it has existed for so long under so many different conditions that it appears to be a fundamental feature of how markets function. This is probability thinking applied to real investment decisions. Component 2. Accept inevitable losses as part of the probabilistic system rather than evidence of system failure. This is where most people break down. You implement a strategy with positive expected value. It loses money for 6 months or a year, and your brain screams that something is wrong. But here's what the mathematics tells us. Even a strategy with a 60% win rate will experience losing streaks. If you have a 60% probability of success on each bet, the probability of losing 5 times in a row is approximately 1%. Rare, but not impossible. Over thousands of trials, you will definitely experience multiple 5-loss streaks. If you panic and abandon the strategy during a losing streak, you guarantee that you'll miss the winning streak that was statistically likely to follow. According to research from Morningstar examining investor returns versus fund returns across 20-year periods, the average investor in equity mutual funds earned approximately 3 to 4 percentage points less annually than the funds themselves, purely because investors bought after periods of strong performance and sold after periods of poor performance. They abandoned probabilistic systems during the inevitable losing periods. Simons avoided this trap by having absolute conviction in the mathematics. Renaissance's models were tested against decades of historical data, validated through rigorous statistical methods, and only implemented if they showed robust edges across multiple timeframes and market conditions. When a strategy experienced losses, the question wasn't whether to abandon it. The question was whether the losses were within the expected statistical range for a strategy with that edge. If losses were consistent with normal variance, Renaissance kept trading. Only if losses exceeded statistical expectations would they investigate whether the edge had truly disappeared. You can implement this thinking by establishing clear criteria before you enter any investment. Don't ask yourself if you want to continue holding during losses. Ask yourself, are these losses within the expected range for this strategy based on historical volatility? If yes, you continue mechanically. If no, then and only then do you reevaluate. This removes emotion from the decision. You're not abandoning a strategy because it feels bad. You're only abandoning it if the mathematics suggests the underlying edge has disappeared. Component 3. Diversify across uncorrelated edges and accept lack of causal understanding. This is the final piece, and it's where Simons's approach becomes almost impossibly difficult for most people to implement purely. Renaissance eventually had hundreds of mathematicians and scientists developing thousands of uncorrelated trading strategies. That level of sophistication is obviously beyond individual investors, but the principle scales down. You can diversify across investment approaches that have different drivers of returns. For example, you might allocate portions of your portfolio to domestic equities, international equities, real estate investment trusts, treasury bonds, and inflation-protected securities. Each of these asset classes has different return drivers. When one underperforms, others might outperform. And over long periods, the diversified portfolio tends to have better risk-adjusted returns than concentrated positions. The key is accepting that you won't know which component will perform best in any given year, and you won't waste energy trying to predict it. You're engineering statistical inevitability through diversification. Now, here's an interesting social experiment I want to run. I want to test whether people who think mathematically about money cluster in certain geographic areas, or whether this mindset is evenly distributed across the country. Drop your city and state in the comments below. I'm genuinely curious whether there are regional differences in how people approach financial thinking, or whether the ability to think probabilistically is randomly distributed regardless of location. Take 30 seconds and leave your location in the comments. Let's see what patterns emerge. The application phase of this framework requires addressing the practical obstacles that prevent most people from thinking this way, even when they intellectually understand the principles. Obstacle 1 is data availability and analysis capability. Simons had teams of PhDs analyzing terabytes of market data. You obviously don't have that. But you actually don't need it for basic implementation. The research on factor investing, the historical performance of different asset classes, the statistical analysis of investment strategies, All of this has been done by academic institutions and published in peer-reviewed journals. You're not discovering new edges, you're implementing edges that have been thoroughly documented. Dimensional Fund Advisors, for example, publishes extensive research on size and value premiums. Vanguard publishes research on asset allocation and diversification. The Federal Reserve Economic Database provides decades of economic data. You don't need to become a mathematician. You need to read the mathematics that professionals have already done and implement their findings systematically. Obstacle 2 is emotional discipline. This is far harder than data access. Knowing that a strategy has positive expected value and continuing to execute it during inevitable losing periods requires psychological strength most people don't have. Simons had an advantage here because Renaissance's systematic trading removed human emotion entirely. Computers executed the trades according to mathematical models. There was no opportunity for fear or greed to corrupt the process. Individual investors don't have that luxury. You're making decisions with your own money, feeling every loss, tempted by every promising opportunity. The only reliable solution I've found, and this is supported by research from behavioral economists, including Richard Thaler examining commitment devices, is to make implementation as mechanical and automatic as possible. If you're investing in index funds for retirement, set up automatic monthly contributions that occur regardless of market conditions. Never look at your account balance during market volatility. Remove the opportunity for emotional interference. If you're implementing a rebalancing strategy, establish clear mathematical rules in advance. Once per year, on a specific date, you rebalance to your target allocation regardless of how each component has performed. You don't think about it. You don't evaluate whether it feels right. You execute the mathematics mechanically. This won't give you Renaissance-level returns, but it will prevent you from being your own worst enemy, which, according to that Morningstar research I mentioned earlier, is the single biggest destroyer of wealth for most investors. Obstacle 3 is social pressure and comparison. Simons could ignore this because Renaissance's returns were so extraordinary that nobody questioned his methods. But if you're implementing a systematic value investing strategy and your neighbor is bragging about his cryptocurrency gains, or your coworker is excited about her tech stock portfolio, maintaining discipline becomes psychologically difficult. Humans are social creatures. We calibrate our sense of success relative to peers. When everyone around you seems to be getting rich quick, using approaches that feel exciting and allow for narrative storytelling, sticking to boring mathematical frameworks that generate steady but unspectacular returns requires enormous conviction. The only defense against this is understanding the mathematics deeply enough that you trust it more than you trust social proof. According to research published in the Journal of Finance examining long-term investment returns, strategies that generate steady, consistent returns over decades dramatically outperform strategies that generate occasional spectacular returns interspersed with significant losses. But the human brain preferentially remembers and values the spectacular wins while discounting the steady gains. Your neighbor who made 300% on cryptocurrency one year but lost 60% the next 2 years will tell stories about that winning year for decades. You, earning 12% annually for 30 years, will seem boring by comparison. But the mathematics is inexorable. 12% annually on $100,000 for 30 years, assuming you don't add any additional capital, gives you approximately $3 million. 300% in year 1, down 60% in year 2, down 60% in year 3, then 12% annually thereafter from that reduced base, ends up with far less. But nobody tells stories about steady compounding. They tell stories about massive wins. Simons understood this deeply. He wasn't trying to have the best year. He was trying to have the best decade, the best 30 years. And by thinking in terms of mathematical expectancy over thousands of trials rather than individual home runs, he built wealth that dwarfed almost everyone who chased spectacular single trades. Now, we reach the mastery level of this framework, the place where intellectual understanding transforms into practical wisdom. Everything I've described so far is theoretically accessible to anyone willing to study the mathematics and implement systematically. But there's one more layer that Simons embodied, and it's what separated him not just from average investors, but from other sophisticated quantitative investors who understood probability thinking. Simons recognized that the edges he was exploiting would eventually disappear. In a complex adaptive system, any pattern that becomes widely known and traded gets arbitraged away. If everyone knows that small-cap value stocks tend to outperform, more money flows into small-cap value stocks. Their prices rise faster than their fundamentals, and the edge diminishes. This is actually happening in real time across markets. Many of the systematic factors that showed robust historical performance are showing diminished returns in recent years, precisely because so much capital is now targeting those factors. Simons's response to this reality was to constantly evolve. Renaissance wasn't executing the same strategies in 2018 that it was executing in 1990. The team was continuously researching new patterns, testing new approaches, discarding strategies whose edges had disappeared, implementing new strategies as they were discovered. This required enormous intellectual humility. Many of the strategies that had generated billions in profits were eventually shut down because the statistical edge had eroded. Simons didn't cling to past success. He followed the mathematics wherever it led. This is the final and most advanced insight. Thinking differently isn't a destination. It's a process. The specific strategies that work change over time as markets adapt, but the meta-strategy of following probability rather than prediction, of accepting losses as inevitable, of diversifying across uncorrelated edges, of trusting mathematics over intuition, that meta-strategy is timeless. Let me make this concrete with an example of how an individual investor might implement this evolutionary approach. You start with a basic systematic strategy, perhaps dollar-cost averaging into a diversified portfolio of low-cost index funds spanning domestic and international equities, real estate, and bonds. This is mathematically sound, has decades of supporting evidence, and is accessible to anyone. You execute this for 5 years, contributing monthly, rebalancing annually, ignoring market volatility. During this time, you're studying market research, reading peer-reviewed financial journals, understanding emerging evidence about factor investing, learning about alternative assets. After 5 years, you've built both capital and knowledge. Now you can evolve. Perhaps you allocate a portion of your portfolio to small-cap value tilts based on the research showing historical outperformance. You maintain your core position in total market funds, but you add this additional edge. You continue learning and evolving. Maybe after another 5 years you add exposure to emerging markets, or alternative factors, or other asset classes that research suggests have positive expected returns uncorrelated with your existing positions. The key is that each evolution is driven by mathematical evidence, not intuition or excitement or social pressure. You're not chasing performance. You're systematically adding diversified probabilistic edges as your knowledge and capital grow. This is how individual investors can approximate Simons's approach without having PhD-level mathematical training or access to massive computational resources. You're not trying to discover new market anomalies. You're implementing documented edges systematically and evolving your approach as evidence evolves. According to analysis from the Social Security Administration examining wealth accumulation patterns across millions of Americans over decades, individuals who consistently implement systematic investment strategies Even relatively simple ones like regular contributions to diversified portfolios with annual rebalancing end up in approximately the top 5% of wealth accumulation for their age cohort. Not because they're making spectacular trades, but because they're following mathematical principles consistently, while the vast majority of people are making emotional decisions, chasing performance, panic selling during downturns, and generally being their own worst enemies. The mathematics compounds over decades into dramatic differences. I want to emphasize something critical here because it's where most people misunderstand what I'm teaching. This is not financial advice. I'm not telling you to put your money anywhere specific. I'm not recommending particular investments. I'm explaining mathematical frameworks that have been documented in academic research and exemplified by practitioners like James Simons. What you do with this information depends entirely on your individual situation, your risk tolerance, your time horizon, your goals, and dozens of other factors that I know nothing about. This analysis is for educational purposes only, based on historical data and mathematical principles documented by institutions including the Federal Reserve, Bureau of Economic Analysis, and peer-reviewed academic research. Nothing presented here constitutes financial advice or investment recommendations. Past performance does not guarantee future results. Markets involve inherent risk and uncertainty. Always consult qualified financial professionals before making investment decisions. My goal is to share mathematical frameworks for thinking about money, not to prescribe specific actions for your individual situation. That said, the frameworks themselves, the way of thinking that Simons exemplified, are universally applicable regardless of your specific financial situation. Whether you're investing millions or hundreds, the principle of following probability rather than prediction works. The principle of accepting losses as part of a positive expected value system works. The principle of diversifying across uncorrelated edges works. The principle of thinking mathematically rather than emotionally works. These aren't get-rich-quick schemes. They're mathematical realities that compound over time. Simons built his wealth over 30 years of consistent application. You won't match his absolute returns because you don't have access to his computational resources or his team of PhDs discovering novel market patterns. But you can match his approach to thinking, and that approach, applied consistently, puts you in a fundamentally different category than 95% of people trying to build wealth. Let me end with a story that captures the essence of thinking differently in the way that Simons exemplified. In 2007 and 2008, during the financial crisis, many of the world's most sophisticated hedge funds collapsed. Funds run by brilliant managers with decades of experience lost 50, 60, 70% of their value. Some went out of business entirely. Renaissance Technologies' flagship fund, during the same period, made approximately 80% returns. How is that possible? How did Simons' fund thrive during the worst financial crisis in 80 years while brilliant competitors collapsed? The answer reveals everything. Most of the funds that collapsed were making concentrated bets based on predictions about how the crisis would unfold. They predicted that housing prices couldn't fall nationally. They predicted that investment banks were too big to fail. They predicted that certain assets were genuinely safe. They were making narrative-driven decisions, and when their narratives proved wrong, they lost everything. Renaissance wasn't predicting anything. The models detected patterns showing increased volatility and adjusted position sizing accordingly. The models identified opportunities created by panic selling and exploited them mechanically. There was no narrative about what should happen. There was only mathematical reality about what was happening, processed through statistical models and executed systematically. When the world was ending for everyone else, Simons's approach to thinking was exactly what it had always been. Follow the mathematics, ignore the emotions, trust the probabilities, repeat 10,000 times per day. That's what thinking differently actually means. It's not about being creative or unconventional in some vague inspirational sense. It's about being willing to subordinate every human instinct, every emotional impulse, every narrative desire to cold mathematical reality. Most people can't do this. Their brains won't let them. And that's exactly why the few who can do it succeed so dramatically. The edge isn't in having secret information. The edge is in thinking in ways that the human brain finds fundamentally uncomfortable, but that mathematics proves correct. If the mathematical framework I just demonstrated makes logical sense to you, hit that like button. Only about 3% of YouTube viewers actually like videos they watch. Be part of that 3% who thinks differently enough to take action when something has genuine value. And remember, thinking differently isn't about being smarter or more creative. It's about being disciplined enough to follow probability when your intuition screams for prediction, patient enough to endure inevitable losses while trusting positive expected value, and humble enough to evolve your strategies as edges change. That's what James Simons did for 30 years. That's what created one of the greatest fortunes in financial history. And those principles, scaled to your level, applied consistently, can transform how you build wealth regardless of where you're starting from today.